Welcome to my channel. Today we're going to be talking about my top 5 real estate ETFs, also known as REITs. REIT stands for Real Estate Investment Trust. Essentially, they're mutual funds for real estate in which investors pool money. A qualifying REIT is not required to pay corporate tax, thus they are treated as a pass-through entity. Some REITs buy properties and rent them, while some develop properties from the ground up. And then there are REITs who focus on mortgages and financials. There are also hybrid REITs who invest in properties and mortgages, office REITs, healthcare REITs, which arguably can withstand any economic conditions, hospitality REITs, and industrial REITs. Mortgage REITs invest in mortgages, mortgage-backed securities, and other mortgage-related assets. They borrow large amounts of money at lower short-term interest rates and use this money to purchase 15 to 30-year mortgages that pay higher rates. To qualify as a REIT, they must invest at least 75% of their assets, and 75% of their income must be derived from these assets. 75% of their income from real estate. They must be structured as corporations and have at least 100 shareholders. They must have no more than 50% of their shares owned by 5 or fewer shareholders. In general, any single investor can own no more than 10% of a REIT. And they must pay out at least 90% of their taxable income, which makes them a pass-through corporation. The first REIT on our list is Dynex Capital, ticker symbol DX. They're an internally managed mortgage REIT that manages a diversified, high-quality, leveraged fixed income portfolio. They're currently paying 13 cents a month at an 8% dividend yield. Dynex has a market cap of $507.1 million, EPS 6.93, and a PE ratio of 2.73, which is really good and could mean further growth. On Friday, February 19th, it closed at $18.88. And looking at the chart, after having a significant drop last year in March 2020, it has had continual, consistent growth. Looking here on the 3-month chart, we can see some good entry points. Could easily be good to get even more shares if it drops down below 18 bucks at some point, even if it's weeks or months in the future. Here we are on Dynex Capital's website. They're focused on capital preservation and provide risk-adjusted returns reflective of the diversified, high-quality leveraged fixed income portfolio. Steady long-term perspective emphasizes diversification, low leverage, and conservative approach to create shareholder value. Primary goals are to generate dividends for shareholders, manage leverage conservatively, remain as owner-operators, maintain a culture of integrity, and employ the highest ethical standards. Under their Form 10-K, they have mortgage-backed securities in the value of $5.1 million, mortgage loans held for investment net $9,405, derivative assets $4,290. Under liabilities, they have repurchase agreements in the value of $4.7 million, non-recourse collateral financing $2,733, derivative liabilities $974. Yahoo Finance, under Dynex's income statement, they have total revenue of $199,000, non-interest expense over $22,000. Their balance sheet, total assets over $3 million, total liabilities over $2 million, and total equity gross $633,000. On MarketBeat, Dynex Capital is a mortgage real estate investment trust, investing in mortgage-backed securities on a leveraged basis in the United States, agency and non-agency, consisting of residential, commercial, and commercial interest-only securities. They have a guarantee of principal payment by an agency of the U.S. government or a U.S. government-sponsored entity, such as Fannie Mae and Freddie Mac. Non-agency mortgage-backed securities have no such guarantee of payment, and it was founded in 1987 in Glen Ellen, Virginia. At 13 cents a share, if say you owned 500 shares, you would get $65 a month just for this one particular REIT. If you owned 1,000 shares eventually, it'd be $130 a month to add to your other dividends, monthly and quarterly. Next on our list is Global X Super Dividend REIT ETF, ticker symbol SRET. SRET is paying 5 cents a month at a 6% dividend yield. SRET, under Global X funds, has net assets of $384 million. Looking at the chart, in the 2-year chart, they did also have a significant drop around February, March, and then have gradually been recovering. You can certainly see some good entry points. Get at least a few shares just below the current price, and then get a lot more as it drops down in price. A very cheap REIT with some good dividend returns. SRET seeks investment results that correspond generally to the price and yield performance before fees and expenses of the selective global super dividend REIT index. The fund invests at least 80% of its total assets in the securities of the underlying index and in American depository receipts and global depository receipts based on the securities in the underlying index. It tracks the performance of REITs that rank among the highest yielding REITs globally, as determined by Selective AG, the provider of the underlying index. Here we are on globalxetfs.com, showing SRET again has a $389.7 million net assets, net asset value of $9.08. Shares outstanding are 42.9 million. Total expense ratio is 0.59%. 79.4% of their net assets in the United States, 10.6% in Canada, 7.4% in Singapore, 2.2% in Australia, other cash 0.4%. These are top holdings, including Dynex right here. 3.44% of their net assets in Dynex. Over 723,000 shares of Dynex, which is over 13 million market value, and some others that I've been a bit interested in. Seeking Alpha points out that they outpaced the index right until the February 2020 market peak, and since then the fund has struggled. Now we know that it's been tough with the pandemic, but these different funds have started to rebound since then. Did a good job of outpacing the Vanguard Real Estate ETF, VNQ, which I have 2 shares of, right before the February 2020 peak. On Market Watch, more of SRET's holdings. You might recognize some of these. I did just put in a limit order to get a couple of shares of KKR Real Estate. Here's Armor Residential, which is also on our list for this video. MGM Growth Properties, a hotel REIT that I'm interested in getting some shares of. Next we have Schwab US REIT ETF, ticker symbol SCHH. They're currently paying 12 cents quarterly at a 1% dividend yield. Schwab's REIT has net assets of $4.63 billion, net asset value of $39.28. They're an exchange-traded fund. They track as closely as possible the total return of the Dow Jones Equity All REIT Capped Index, composed of U.S. real estate investment trusts classified as equities. Looking at the 2-year chart, after the significant drop in February and March of last year in 2020, they've been consistently recovering since the pandemic. They last closed at $39.47 on February 19th. It could be the best idea to get below $38, maybe in the low 37s. Of course, you could get 2 or more shares in the low 39s or even high 38s and average down as the cost goes down at some point. Would totally be worth it getting some shares at a lower cost, even if they cut their dividend temporarily. Now we see that they were increasing their dividend gradually before the pandemic, from 12 cents quarterly to 33.55, and then recovering from the pandemic, they were increasing it again up to 37 cents in December. They're supposed to be paying 12 cents per share quarterly. At 12 cents quarterly, with 500 shares, it should be $240 a month to add to your other dividends. Schwab REIT's top 10 holdings include American Tower Corp, Prologis, Crown Castle International, Public Storage, Simon Property Group, and several others. Schwab REITs, top 10 sectors. Specialized REITs are 43.97%. Commercial REITs, 41.37%. Residential, 13.78%. Diversified, 0.79%. And real estate development, 0.02%. Next, we have iShares Global REIT ETF, ticker symbol REET, currently paying 19 cents quarterly at a 3% dividend yield. iShares Global REIT has net assets of $2.5 billion, net asset value of $24.80. They track the investment results of the FTSE EPRA Nareit Global REITs Index, designed to track the performance of publicly listed real estate investment trusts in both developed and emerging markets. Generally will invest at least 90% of its assets in the component securities of the underlying index and investments that have economic characteristics that are substantially identical to the component securities of the underlying index, and may invest up to 10% of its assets in certain futures, options, and swap contracts, cash and cash equivalents. And looking at the 2-year chart, see again in February and March of 2020 that they did have a significant drop from being up in the 24.80 range. And then they've been pretty consistently recovering. Could be overvalued, could drop down to the $22 or $23 range anytime soon. I think when I first got into it, it was maybe a little bit under 23. A couple shares, I wouldn't mind getting some more, but kind of waiting until it goes down some, preferably. The dividends may seem like pocket change, but they add up, especially when later on you add more shares. And there's so many different dividend stocks to get anyway. And their last close at February 19th was at $24.84. iShares Global REIT ETF was formed in 2014. Net assets over $2.6 billion. Shares outstanding 107.2 million. Currently paying 19 cents quarterly. So one way to look at it is if you had, say, 500 shares, it'd be $95 quarterly. So $380 a year to add to your other quarterly and monthly dividends. Here's MarketWatch's list of REIT's top 25 holdings: Prologis, Digital Realty Trust, Public Storage, Simon Property Group, Avalon Bay, Equity Residential. The last REIT on our list is Armor Residential Incorporated, ticker symbol ARR. They're paying 10 cents a month at a 10% dividend yield. Armor has a market cap of $776.9 million, an EPS of negative 3.57. Founded in Vero Beach, Florida. Here are some of their executives. Looking at the 2-year chart, again, we see in February and March they had a huge drop last year in 2020. You can also see some long-term recovery since the pandemic began. Some good entry points, a little bit lower than the current price. You don't want to chase a stock or REIT or ETF. You don't want to buy it right at its current price and then weeks or months later it's down much below that, just so you can get those dividends as soon as possible when you're really going to save much more money by buying the shares price cheaper. And they closed on the 19th at $11.90. Looking at their balance sheet, their total assets are $5.5 million, liabilities at $4.5 million, and total equity gross at $938,304. Armor invests in residential mortgage-backed securities in the United States, primarily consisting of government-sponsored entities and government national mortgage administrations issued or guaranteed securities backed by fixed rate, hybrid adjustable rate, and adjustable rate home loans, as well as unsecured notes and bonds issued by the government-sponsored entities and the United States Treasuries and money market instruments. Also invests in other securities backed by residential mortgages, for which the payment of principal and interest is not guaranteed by the government-sponsored entity or a government agency. With a dividend of 10 cents a month, if let's say you have 500 shares, that would be $50 a month to add to your dividend portfolio. Or let's say 1,000 shares times 10 cents. Easy math problem, that's $100 right there. If you're uncomfortable investing a large amount of money into mortgage REITs, in case there's some kind of mortgage crisis, you could always put more money towards the REITs that have to do with healthcare, as they should be able to withstand any kind of economic conditions. Plus, hospitality REITs should probably be able to withstand a mortgage crisis, such as a housing bubble crash. As always, I am not a financial advisor. This is strictly for entertainment purposes only. It's up to you how much of your portfolio you invest in REITs. You could choose to put just a small number of shares in each of these right now, and you could choose to later on buy a larger number of shares when they go down in price. And if a mortgage crisis was to happen, you could always wait till it starts to recover, and then that could be a good time to purchase more of the mortgage REITs. Thank you for watching. Don't forget to like and subscribe, and have a great day.